Hello, in this video, we'll be going over current liabilities, specifically accrued expenses. A liability is a present obligation to transfer an economic benefit. In other words, it is a debt that is owed to another person or another entity, another company. A liability can be classified as a current liability or non-current liability. A current liability is an obligation or a debt that is payable within 1 year from the balance sheet date or within the firm's operating cycle, whichever is longer. For purposes of this video, we will assume that all current liabilities are payable within 1 year, as that is typical for the majority of companies. Current liability can be satisfied, or I should say paid, with current assets. Oftentimes it's with cash, or it can also be with accounts receivable or inventory, or it can be exchanged for other assets depending on the circumstances. It can also be satisfied when one current liability is paid off by issuing a different current liability. So let's get into accrued expenses, which is one type of current liabilities. Accrued expenses are expenses that are already incurred but not yet paid. So they have to be recorded as a liability on the balance sheet because the corporation owes them but has not paid them yet. Accrued expenses are recorded via what's called adjusting entries. Adjusting entries are just normal journal entries with a debit and credit, except that they are booked at month end, quarter end, or year end to accrue for those expenses that have been incurred but not yet paid. And they're usually combined under a single caption in the balance sheet, so you won't see the different types of accrued expenses broken out on the face of the balance sheet, typically just as accrued expenses. Some common examples of accrued expenses are salaries payable, income taxes payable, and interest payable. So think of salaries payable when we say that expenses have been incurred but not yet paid. If a company has a 12/31 year end and their employees get paid, in arrears. So for the period ending, let's just call it for the period from 12/16 to 12/31, whatever the employee worked, they won't get paid for that period until January 7th, let's just say. They get paid a week later. So when we close the books on 12/31, those employees have worked for those 2 weeks that we owe them their salaries. So that is a time when we would record an accrued expense, and call it a salaries payable probably, and for the time for those 2 weeks that we owe those employees their salaries but have not yet paid it, and it will be paid the following year on the 7th. That's just one example of what an accrued expense is. Let's talk about accrued interest. We've discussed in previous videos about companies issuing notes payable. So we're going to continue with this similar example. On May 1, Affiliate Technologies borrowed $700,000 cash from First Bancorp under a non-committed short-term line of credit arrangement and issued a 6-month 12% promissory note. Interest was payable at maturity, so at the end of the 6 months. Assume the fiscal period for Affiliate Technology ends on June 30th, 2 months after the 6-month note is issued. So what we're talking about, if I draw a timeline, here's May 1, and here's June 30th, which is this company's year end. And then the note is a 6-month note, so it will be due on November 30th or December 1st. I'm just going to put November 30th here. So the company closes their books right here on June 30th, and therefore they need to accrue this 2 months worth of interest that they owe on this note. They won't have to pay until June, until November, but they still owe it and need to accrue that interest. So let's go through the journal entries on May 1. On May 1, the company received cash $700,000 and recorded notes payable $700,000. To record the interest on June 30th, they will take the face value of the note, $700,000, times the interest on the note, and that is an annual interest rate of 12%. But we are only accruing interest for the 2 months, from May 1 to June 30th. So only 2 months out of the 12-month year. So when you take 700,000 times 12% times 2/12, it gives you $14,000. So we're gonna, on year end, we're gonna debit interest expense, $14,000, and credit interest payable, $14,000. The interest payable is what we will refer to as your accrued expense or your accrued liability. Now, it's due on November 1st, not November 30th. I got my months mixed up. But in any case, we have our got issued a 5/1. We have a 6/30 year end, and it's due. The payment is due November 1st. November 1st. We have already accrued interest as of June 30th, call it X1, for $14,000. Now, fast forward to November 1st, which is the second fiscal year for this company. It's part of their second fiscal year. We are going to have to pay off this note. So we debited notes payable on $700,000 because we recorded the credit on May 1st. The interest payable that we recorded from June 30th, we're going to debit that. So this is from right here, this interest payable account that we credited on June 30th, right? That's a liability. Now we're going to debit that amount. And we still owe interest for the next 4 months, right? We've already accrued the interest for the first 2 months. Now we have to record the interest expense for the following 4 months. And we're going to do that by taking the face value, $700,000, times our annual interest rate, times the number of months we're calculating interest for, which is 4 out of the 12 months. So, and that gives us $28,000. So we're going to debit interest expense of $28,000, debit interest payable $14,000, debit notes payable $700,000, and credit cash for $742,000. I want to note that if just $700,000 times 12% times 6/12, because this is just a 6-month note, right? So you would get $42,000, which is the $700,000 plus 42 was the amount that was paid out. The $42,000 of interest, the interest expense is booked in total for $42,000. It's just that $14,000 of the interest expense was booked in the first fiscal year, and the remaining $28,000 is booked in the second fiscal year. And the $14,000 of interest expense was recorded in the first fiscal year as of June 30th, but it wasn't paid out till the following fiscal year. So this is an example of an accrued expense because the expense has been incurred but not yet paid. That's what we did on June 30th. Another type of accrued expenses that we typically see are related to all payroll types of expenses like salaries, commissions, and bonuses. And these arise when the employees have provided services but will be paid after the financial statement date. Kind of like the example I gave a few slides ago that employees work from December 16th to the 31st but don't actually get paid for that time period till the following year, example, January 7th. If the following 4 conditions are met, then the company clearly has liability and they must record that accrued liability. So the 4 conditions to record an accrual of paid future absences Okay, this is for like vacation, 6 days, and other types of future absences. Or the obligation is attributable to employees' services already performed. I want you to think of accrued vacation, that an employee accrues vacation as they work, but they don't necessarily take that vacation all in one year because they can have the vacation rolled over to the following year. However, the company will still owe the employee the vacation and have to record a liability if these four items are conditions are met. So number one, the obligation for services has already been performed, meaning the employee has worked. Number two, the paid absence can be taken in a later year. So, meaning if you have accrued vacation that you haven't used all in one year, you can take it in the future, in future years. Number three, payment is probable, which means the employee will either likely take the vacation, or if they no longer have a job, they will be paid out on that accrued vacation. And number four, the amount can be reasonably estimated. If all those four conditions are met, an accrued expense for vacation, 6 days and whatnot needs to be recorded. Let's take an example. Davidson Getty Chemicals has 8,000 employees, each earning 2 weeks of paid vacation per year. Vacation time not taken in the year earned can be carried over to subsequent years. During 2027, 2,500 employees took both weeks vacation. But at the end of the year, the remaining 5,500 employees had vacation time carryovers as follows. So out of their total 8,000 employees, 2,500 took all their vacation during the year that they earned. And so they have no vacation to carry over. And they tell us that 2,000 employees took one vacation. And so when you take the 2,000 employees times 1 week vacation they can carry over, they have 2,000 weeks to carry over. And the remaining 3,500 employees didn't take any vacation during the year, which means that they're going to carry over their entire 2 weeks, so which leaves 7,000 weeks to carry over into the future, leaving us with a total of 9,000 weeks that was earned, that of accrued vacation that was earned by employees but not yet taken. The problem further tells us that during 2027, which is what all this information is about, the compensation averaged $600 a week per employee. However, in 2028, when vacation time carried over from 2027 is taken, the actual amount paid to employees is $5,700. Let's work through this piece by piece because there's a lot of information on this problem. And so we're going to first record the vacation that was taken by the employees for the full 2 weeks in the current year in 2027. So we're going to look, the 2,500 employees took both weeks of vacation, right? So that's 5,000 weeks worth of vacation that they actually took during 2027. And 2,000 employees only took 1 week and had 1 week to roll forward to the following years. So 2,000 employees took 1 week, right? So that gives you 2,000 weeks of vacation that was earned and taken in 2027. So total of that is 7,000 weeks, and it tells us that in 2027 the compensation averaged $600 a week. So that gives us $4.2 million. The way we record that during 2027, so this is all during the year, we're going to debit salaries expense for $4.2 million and credit cash or salaries payable, depending if some of this was for the year end, and we'll just need to accrue the part that we're going to pay in January of 2028. And so here's that math of 2,500 times 2 times 600. and then 2,000 times 1 week times 600. Okay, back to the same problem. Now we're going to, in 2027, we had 9,000 weeks that were carried over into the future to 2020 and beyond. And we owe that to our employees as accrued vacation, but we have not yet paid it out. So we're going to take the 9,000 weeks times, we're told the employee earned an average of $600 per week, which equals to $5.4 million. So 12/31/2027, our year-end adjusting entry will be, we're going to accrue salaries expense for the $5.4 million, and we're going to record a liability. And in this case, it's called liability compensated future absences. Typically in a corporation, it will be called vacation liability. So, or vacation payable, I should say. And that's also a credit of $5.4 million. The rest of this problem says in 2028, when the vacation time carried over from 2027 is taken, the actual amount paid to employees is $5.7 million. So we're going to assume what this tells us that full 9,000 weeks of vacation were all taken in 2028. However, when we look at the salaries per employee for each one of those vacations, accrued vacation, the total expense ended up being $5.7 million. So we need to true up our journal entry accordingly during 2028. So here's our 12/31 year-end entry that we did before, where we accrued $5.4 million. And when I say accrued, it means we recorded the liability. And when those 9,000 weeks were taken in 2028, and the actual amount paid was $5.7 million, we're going to, whatever we had as our liability, we're going to debit. So we're going to debit liability $5.4 million, right? Because that's what we recorded. We have additional salaries expense of $300,000, and then we paid out 5.7. So credit cash or salaries payable for 5.7. So notice that in total, the total vacation taken for those 9,000 weeks ended up being $5.7 million. We recorded $5.4 million of salaries expense in 2027, and the remaining $300,000 of salaries expense in 2028. But in total, $5.7 million of salaries expense has been recorded over those 2 years. Now, another typical year-end accrued expense are bonuses. And many times corporations offer bonuses to their employees in hopes that it'll help them perform better. Bonuses are typically paid out based on performance measures, which can be based on earnings per share, how much income, net income or operating income the corporation has earned, or it could be non-financial measures as well, based on customer satisfaction or product quality. There's various ways a company decides how they're going to determine what their bonuses are. But when at year end, so assuming we have a 12/31 year end, the company will estimate how much bonuses have been earned for that year, and usually the bonuses will not actually be paid till either February or March of the following year. But since a lot of the bonuses are based on the year-end net income or earnings per share, the accrued bonus has to be estimated at 12/31. And this is not just a random estimate, it's a calculated estimate based on what the company thinks the net income will be. So, and then what they'll do at year end is they will debit bonus expense or salaries expense for a certain amount, and then they will credit bonus payable at year end. And then once, let's just call it on March 1st of the following year, those bonuses are paid, they will debit this bonus payable amount for however much it was. And if the amount of bonuses that are actually paid are different than this payable amount, then they will debit more or less salaries expense depending on what the final amount will be.